Good day and welcome to the Korner BCI Flexible Fund Market Commentary, Manager Commentary for the period to 31 December 24, but with some commentary up to the end of January. This is the fifth in our series, and that started with the big picture through asset market performance, local and offshore, and this now culminates in this one. Obviously, there are going to be certain references to some of the other videos. We would particularly recommend anybody who wants some of the granular detail on some of the underlying holdings to either look at the December 24 local portfolio review. Quite a lot was in the June 24 review, or December 23. That way we'll just get a slightly deeper understanding of some of the holdings. As mentioned, we're going to do some updates to the end of January, but really this covers the year and the 6 months to December. A quick reminder on the positioning of the fund. We've done this before, so I'm not going to dwell on it, but it is by design, gives us maximum flexibility on asset class and style for that matter. Benchmark, very much equity leaning, 70% SWIX, 15% JSE listed property, and 15% STEFI. Our real objective, though, is to offer investors long-term inflation-beating returns, but to do that in a way that manages the risk, whether it's measured by standard deviation or drawdown or just simple volatility. The fund is very much currently positioned towards SA equities, and the main reason, and we anticipate that it will remain this way, is because A, that's where we see value, and secondly, we have almost all our clients have significant offshore holdings, either in segregated portfolios or through local structures that give them that offshore allocation. So we feel no sort of burden, in inverted commas, to hold significant amounts of offshore assets to try and offer a degree of diversification. And then also, as you'll see, the full portfolio has quite a significant tilt towards what we would classify as net asset value plays. Our core philosophy is value, but we are not, fanatical about that. We, sometimes embrace growth assets, but probably sit somewhere between classic value and growth at a price. All right, just looking at the fund positioning as at the end of December. If you look at this pie chart, which shows the asset allocation across the main asset classes, 76% in equity. That includes the pref allocation, and that's just really so that we can compare apples with apples from an MDD point of view. 13% is cash and money market, 11 sitting in bonds, and nothing in property. If you look at our benchmark, 70% is SWIX, 15 STEFI, and 15 in SA property. So clearly, we have not been afraid over the years to express ourselves from an asset allocation point of view. Here you can see the evolution of the equity holding, for example, to a current holding of 72 in pure equity and 76, give or take, including pref equity. And you can see a very significant and steady decline in the cash and money market and income fund allocation over time. Interesting to see that at 72%, actually a slight contraction in the equity allocation from where it was a year ago. It's pretty obvious. Equity, we're slightly overweight, particularly if you include prefs. Cash, we're slightly underweight. Property, significantly underweight. And bonds, very underweight because we have no allocation to them. Then just explaining the weightings, we think the equity overweight is pretty obvious. Valuations are attractive in the assets that we hold, low PEs where we are playing PEs, and some very attractive discounts to NAV. And then a lot of our equities are offering dividend yields that are similar to cash, and quite often similar to listed property and even bonds, particularly if you were to lob tax off. The bond and pref allocation, pretty simple as well. Bond yields much better returns than property, we feel, probably with better visibility and probably less asymmetric returns than you would probably see in property, and obviously bond yields better than cash. And the big bank prefs, not a big allocation, about 3.5%. You're being compensated with a great running yield at 80% of prime while you wait for what we believe is the inevitable delisting as they become quite expensive debt. The underweight property we're going to unpack in a lot more detail, and then really cash neutral, largely cash neutral, but we've tilted very much towards income rather than pure money market funds. So the big question as an investor that you may be asking is how has our underweight listed property position affected the performance? And the only way you can answer this is to examine different time periods. So if you take a 1 year performance, you look at the 1 year performance on the South African listed property index, you can see, especially to the end of December, had a good run, being 21% up, as you can see in that table at the bottom, which comfortably beats the capped SWIX. But obviously our equity bucket maybe did a little bit better than that, so maybe the performance differential or the performance pain not as significant as it might have been had we been more classically invested. And then on the medium term, interestingly enough, being underweight property actually helped. As you can see on a 5-year view, the listed property index is down 11% versus a capped SWIX of being up 49, and on a 3-year view, largely neutral. And then if you look further out, not that the fund has a 10-year history, had we been going back to 2018, sort of middle of 2018 when the fund launched, being underweight property has actually worked out very nicely. So of course the big question now is if you look forward, are we not saying that this current level on that index of 382 represents a good opportunity, and that we should capitalize on having avoided it for 5 or 7 years? And we still feel that that South African listed property is not yet compelling. Partly explained by the underperformance over the last 10 years. Some of the reasons for that, and what you can see on the right there, it's a little bit crude. It takes the R2035 yield, the blue line with its trend line, versus the listed property index. As you can see, 10 years ago, yields were trading at a reasonable discount to the bond yield, and that really is in large part, I think, explains it. So not only were the yields at a yield discount to bonds, but in many cases, even sort of taking the fairly pedestrian growth that was forecast at those times, was not really getting you to a break-even yield after, say, 2 or so yields. So that was kind of from a simple yield perspective what we think hurt it, but more importantly, it was supply and demand. So 10 years ago, 7 years ago, a lot of supply coming online, particularly commercial, whereas demand wasn't really keeping pace. One of the reasons for that obviously was COVID's impact on work from home, but that's a more recent phenomenon. But I think what you've seen over an extended period of time, administered prices, so rates and taxes, utilities, all putting a lot of pressure on tenants, and then also hurting landlords because they were having to invest, for example, in backup power and having to pay more for unrecoverable utilities, etc. So in large part what we're saying is tenants were pushing back because the rentals together with the utilities were becoming progressively more of a noose around their neck, and then on the other hand you had a lot of supply, so really just a very significant imbalance. And then of course a little bit more recently we've seen e-commerce starting to have an impact, but we think that that's still early days. So if you go back to our hypothesis 10 years ago and in 2018 when the fund was launched, we saw this scenario playing out, and we believe in many cases this is still relevant today. This graph is old. We did show it in June of 24, so the data is slightly stale, but it just really tries to illustrate the fact that from those heydays in 2018, 2019, but you have to be honest, even in that run-up 2014 through to 2019, although there was distribution growth, it wasn't phenomenal, but as you can see, after that, a phase of structural decline in distributions, a slight increase or pickup in the 2025 year. But if memory serves, the current yield on the listed property index, which is obviously taxable, is sitting at about 7.8%, I think, on a historic. So still not compelling. You can see Vukile kind of the one standout there. So we hope that defends, in inverted commas, the underweight of, well, completely no allocation at all to listed property. And we're happy to engage with investors and clients should you wish to engage on the topic more. Then moving on to the equity bucket, which at 75%, 3/4 really is the all-important one. A couple of high-level comments, very exposed to financials, as you'll see in a second. Very, very limited resources allocations. In fact, we added some Anglos and Billetins recently, but we still run very underweight resources, which, as you saw in the asset market reviews and in the underlying portfolio commentaries local, that's actually worked out really well. We've got a significant allocation to NAV plays, both classic, in terms of investment holding companies with visible discounts, all the way through to what we would classify as sort of peripheral NAV plays. We've got a reasonable allocation to private equity, which is obviously linked to that NAV position. Our EPS holdings, so where we're looking for earnings plays, we really favored lower PEs with reasonable earnings growth. So we enjoying, attractive PEG ratios. I believe we're enjoying attractive PEG ratios. And then you'll see in a second, very, very differently positioned to the benchmark. So both at an asset allocation level, but also in the underlying equity bucket. We're not afraid of mid and small caps, and we're actually reasonably equally weighted, as you'll see in a second. So it's a very busy chart. On the right-hand side is actually the weighting of the portfolio as of the 31st of December. As you can see, the biggest holding by way is African Rainbow Capital at 9%, followed by Standard Bank, and effectively those two have swapped positions. ABSA also quite a significant holding at 8%. I'm not going to go into the story too much, but both those banks offering great dividend yields, reasonable earnings momentum, maybe a little bit more so in Standard Bank than in ABSA, but we feel that as the economy picks up, lower interest rates start benefiting. Some of those reversals will help drive ABSA. But the bottom line is, when you're on a 7-odd PE and an 8% dividend yield, you've actually got quite a lot of room for error. And then some of the other bigger holdings, you can see some of the moves are the ones in bold. Aspen has come down on a combination of us trimming those a little bit just before the results. Bell obviously has come down in part because we took advantage of the delisting offer. Ethos Capital, in spite of the great unbundling, is up quite significantly from 5 to 6.3. Naspers much the same. 91 is up a bit in spite of the fact that the price is disappointed. So that really tells you we've allocated a little bit more capital. TFG, largely the same. Wilson Bailey has increased quite significantly, as you can see there. And then also we've allocated more to Mondi. So in large part, the portfolio looking quite similar. As you can see, quite a few shares sort of in the 3 to 6% range. So we believe a fairly well-balanced portfolio. We understand the concentration risk in some of these holdings, and we are comfortable that we're in good company and that the holdings can be absorbed if need be by the market. So this is a little bit of an obscure graphic, but what we wanted to illustrate, and if you go back 5 years or 10 years, the top 40 was the de facto standard. And what we just wanted to illustrate is how volatile the the weightings have been in the top 40. And this just goes back to December 2020. So that's really a 4-year period. You can see that, Naspers was 19%, then it shrank to 9%, now back up to 13%. But you can see after the BHP PLC structure collapsed, it's gone from 12% in 2020 to not even featuring in the top 10 holdings. A similar picture for Richemont. If you look at Richemont in 2022, for example, obviously after the reweighting of BHP and Naspers, it became the biggest play. And then obviously with the depository receipt structure conversion or change, they too now have seen a significant slide in their weighting, such that they are no longer in the top 10. So a lot of volatility, and I think that's important because, you know, had we been modeling on these holdings, often you would be upweighting at exactly the wrong time. Whereas if you look there, as we'll see in a second, we've been fairly consistently exposed to, let's call them some of the more consistent positions, so the likes of Standard Bank and ABSA, and even our Naspers holding are fairly consistent in spite of a lot of volatility in the constituents. But then probably more important, just to cast your mind back to what the benchmark looks like. So what we've got now, we're no longer looking at the top 40 index, we're now looking at the SWIX, and basically we're showing you the portfolio as it was 31 December compared to the SWIX. You can see holdings that we no longer have or don't have. FirstRand, which we got out of finally recently, Capitec, Goldfields, MTN, and British American Tobacco. So you can say 5 of the top 10 we have no holding in. We're very underweight 3 of them, and then we overweight 2. So very underweight Naspers, and have been quite consistently. Still underweight Anglos, but we are building that position up. And then overweight Standard and ABSA, you know, with the holding of 7 and 7.8 respectively. But then there are a lot of holdings where we have what would classify as top 10 weightings, you know, things like African Rainbow Capital and Aspen and Ethos and TFG, Old Mutual, Bell, which don't feature, you know, at all in never mind the top 10. Many of them don't even feature in that index. So you know, the position or the equity bucket is positioned very differently from our equity benchmark, and I think it's testimony to the fact that we are allocating capital where we see opportunities, and there's virtually, I wouldn't say zero, but very low correlation to the benchmark, and we're definitely benchmark agnostic. All right, quite a few of the plays we've mentioned it many times are what we would classify as NAV plays, so really where you're looking at the asset value. Obviously, some of them are classically NAV. So if you look at investment holding companies like African Rainbow Capital or Ethos, or, you know, Naspers we put in that camp, or Remgro or Raynet, or you know, all of those you can argue have underlying investments, and those shares trade at a, let's say, a 35 or a 40% discount to that NAV. But there are other assets, things like Argent, Bell Equipment, New World, Cup, even City Lodge, which we don't hold as NAV plays, but where we feel the NAV either offers an opportunity for a value unlock, for example, through corporate action, or we believe it offers quite significant downside protection. And that, as we've discussed previously in some of our portfolio commentaries, was the hypothesis around Bell, and it worked out very nicely. And I think some of these others, as we'll see in a second, have similar optionality. So quite a busy chart. What we're trying to illustrate here is that, you know, obviously things like Remgro and Raynet and Ethos and African Rainbow Capital are sort of investment holding companies, but, you know, there are other businesses that trade at discounts to net asset value or book value. So things like Bell Equipment and Argent and New World, and we believe City Lodge, particularly if you consider the realistic property value, equally a company like Cup trading at a deep discount. So what we're trying to illustrate here, the green ticks illustrates where there has been some sort of unbundling or corporate action to unlock value. And obviously we've seen that in Remgro, more recently in Raynet with the offloading of the final British American Tobacco holding. Ethos is already through Brait unbundling, etc. So we believe that the value unlock from these NAV stories could come from, one, unbundling or them selling assets, possibly returning that through dividends, or through share buybacks, which is the second possible driver, particularly when the register becomes quite tight and let's call them the weaker holders have been flushed out of the system. And then finally, sort of with the corporate action, the delisting potential, we saw that in Bell Equipment. The African Rainbow Capital shouldn't be a green tick, but management there have already indicated that that they are reconsidering the listing, and then obviously Ethos has indicated their long-term plan to no longer have a listed structure. So we would argue that quite a lot of these have a couple of levers at least, so in the case of some companies like CUP, we think, or Argent or New World, for example, and African Rainbow Capital for that matter, they actually offer multiple possible value unlock scenarios. And many of them will not actually be one, they will actually be a combination. And in fact, if you look, for example, at an African Rainbow Capital or an Ethos, the very process of unlocking value through unbundlings and asset sales gives you the cash for the share buybacks, and then that discount obviously causes the leadership to question the listing and incentivizes the astute to delist. So the point is that there's a lot of method in the madness. We feel that companies like New World, for example, have decent operating company prospects. We believe that there's a significant corporate action potential and an opportunity within the portfolio, and that somewhere along the line something will crack, just as we saw it in Bell Equipment, where the family decided to try to take it private. Obviously, some of these things like York and maybe the City Lodges, there may be anchor shareholders who need to be canvassed beforehand, and maybe there sometimes be a political agenda, or let's call it a non-alignment of shareholder interests, but that doesn't discount the fact that there is opportunity, particularly if you can get those shareholders on board. All right, some of our more recent activity, and this is not just in the 6 months to December. We added Anglo American and BHP Billiton. We also added quite significantly to Mondi after the Trump election victory, particularly, and then putting out disappointing guidance. We think it's a really well-placed business, and we believe it'll do well, but do understand the short term is likely to be a little bit bumpy. I'm talking Mondi, obviously BHP. The hypothesis is that demand for their materials will continue, and they're a very low-cost producer. Then we added to all the usual suspects: CUP, Fushini, AIL, African Rainbow, Ethos, Amplats, 91, Coronation, York, and ABSA. We reduced or significantly sold down Bell. So there was a time in the year where Bell was actually our single biggest shareholding. Obviously, then the price ratcheted up to 50 Rand. Indicative was around 52. We got the feeling, having consulted with others in the market and shareholders, that the risk of the deal failing was actually fairly significant, and took the view that a bird in the hand is better than two in the bush. So we cut our position quite significantly, and we actually cut those at a good level. Let's call it around 50 Rand a share. Share currently trading around 40, 42 Rand. So that worked well in absolute terms, but also I think the fact that we managed to lock in at good levels was good. And then we trimmed occasionally some of our overweight positions, particularly when they were in excess of fair value. So, let's say Aspen, I think was 230 just before it announced results and after the run. Standard Bank equally, Coronation, TFG, and Naspers. So all of those at a point in time had valuations which we thought were stretched, probably slightly above short-term fair value, but also we had concerns about the weighting. Now, not all of them would have been 8 or 9% of the equity bucket. Some of them might have only been 5 or 6, but bottom line, we felt sufficiently compelled to trim those. And generally, that's good. But I must say that very much at the periphery, we're not trading, we're not buying and selling. We're simply expressing our view on fair value. And then we sold out completely. Some of these were actually quite big holdings in the past. So if you look, Discovery and ShopRite at a time were actually quite big holdings in the portfolio. British American Tobacco First Rand we're also out of now. Discovery was, as we've discussed before, us falling out of love with the story. British American Tobacco, we feel that the time is right to sort of seriously consider finally exiting that model, and I think Raynette sort of echoed that. And then ShopRite and First Rand, both great businesses, but relative valuations looking a bit stretched. Then looking at the minimum disclosure document to the 31st of December, performance was great. very, very happy. If you look on a 1-year view, almost 22% performance versus a benchmark of 15. So very, very nice outperformance there. And we always say the ASISA category, because of the mishmash of strategies, is kind of irrelevant. But if you look over 3 years in aggregate, 40 versus 30 and 63 versus 57. So happy on the 1, 3 and 5 year. If you look at the annualized on the 3 year, beating very, very comfortably, and even on the 5 year, bearing in mind that, when the fund was launched in 2018, there's a little bit of a build-up period. So we're very happy to see the 5-year performance. But equally important, because of the whole delivering growth but managing the downside. If you look at the top line, the fund on a 1-year view, obviously courtesy of the significant outperformance over 1 year, delivering 10% standard deviation. So obviously volatility in returns versus a benchmark of, let's call it 7. So not great, but obviously still, given the fact that we're almost 7 percentage points outperforming, that's not too bad. But more importantly, looking at the 3-year standard deviation, still below that of of the benchmark, but with much better performance. So if you look 3-year aggregate performance, let's call it 40% versus 30, and in spite of that, we've been able to deliver, let's call it 10.7 in standard deviation versus a benchmark of 11.6. Put differently, looking at the maximum drawdown over 3 years was 7.4 versus a benchmark of 10.8. And then if you look at a calendar year, biggest drawdowns, 21, or let's call it 22 versus over 24. So short term, there's some volatility in the returns, as you would expect when you get the outperformance, but medium to long term, we're still very comfortable. Also pleasing is the total investment charge, which we expected to stabilize sort of in the 130 to 135 range. As you can see there, as at September 24, sat at 1.31%, down nicely from 1.45 a year ago, and 1.43 in the previous on the previous reporting period. So very, very pleased to see that, and we think that'll probably largely hold as we've deployed a lot of the capital and are no longer holding funds that are inflating over and above the management fee, or our management fee. Distributions, another important part. If you look, 1.86 cents of distributions to June, and then 2.78, so a nice pickup. That's obviously, as things are normalizing, equates to a yield of 3.4%. A lot of people would say, but we're not there for the returns. But if over, let's say, a more normal period, if the fund was going to deliver 12% and we can get 3.5, for example, of that 12 in yield, we are very, very happy. So we are not ashamed to seek yield, both dividend and other. All right, on the fund outlook, and there's obviously a caveat to this. We, in our big picture and in the asset market, spoke about some of the risks, a lot of them coming from the new US administration. So as we say there at the bottom, 2025, particularly the beginning, is going to be volatile, and you've got to strap yourself in nice and tight. Having said that, though, and it's not just us sort of believing our own nonsense and thinking we walk on water because of a good year or two, but we do feel the asset mix is right for where markets are, and we're very confident that the equity bucket offers good return prospects. And I think one of the important things is that we generally feel that the portfolio, the equity bucket, offers what we would call asymmetric upside, so more upside than downside on the medium term. And often that is driven by very, very low valuations and big discounts to NAV, with underlying NAV components, the investees themselves, actually being quite strong. So we feel that the fund is well placed for a better South Africa, let's say a 2.5% GDP growth scenario. But if that happens, we believe it will do even better. But the reality is we don't need it. ABSA on a 7.5 PE really doesn't need SA to see a purple patch. We just need some semblance of sense in the valuations. And although we'll remain rooted in our philosophy around buying good businesses at fair valuations. We're not ridiculously married to value, as was evidenced by the fact that we started buying resources counters, even though we understand that that sector is going to be bumpy. In closing, we'd like to thank all our investors in the fund, our clients generally, for the support. We hope that you've enjoyed this video, but more importantly that you're happy with the performance, but more importantly, the positioning of the fund. And as always, we thank you for your time and attention in this, and we welcome your input and your engagement. Thank you.